With that, may I now move on to the next session. The format in general of this conference is that it brings together leading professionals with leading academics or executives who have experience in both the industry and the academia. So Lukasz Pomorski is such a bright example. The next session is going to be on institutional investors and ESG, financial and real effects. Actually, the session had been scheduled to be moderated by Mrs. Aggelopoulou, but unfortunately, due to a very last minute circumstance, Mrs. Aggelopoulou got sick, so she will not be able to do the moderation. So I'm going to have the dual role of moderator and speaker in this session. So may I introduce Lukasz? So Lukasz Pomorski is portfolio manager and a senior vice president with Acadian Asset Management, a very well-known fund. Before that, Lukasz was managing director and head of ESG research in AQR Capital Management. Lukasz also has a rich experience in the academic world. So he holds a PhD from the University of Chicago. He has published in the very, very top finance and economics journals. He has held faculty positions at Toronto University. Before that, he had also spent time at Yale. And nowadays, he's also an adjunct professor at Columbia teaching the ESG course. He has also recently authored a widely circulated book on ESG. So, Lukasz, it's a real pleasure to have you with us today. The next 15 or so minutes are fully yours. Thanks again.
Thank you so much, George, for this very, very kind introduction and for the invitation to present. I will share my screen, and the title of the talk is borrowed from the book that I published that George kindly mentioned just now. I don't want to talk about the book alone, but I do want to tell you why I wrote this. I wrote this because there was, and I think still is, a lot of just confusion, a lot of muddled thinking in the area of sustainable investments. And I wanted to bring my experiences, both, the industry side, the side that is more academic driven, the side that may be sort of working on a number of committees at the PRI, IGCC, etc. I wanted to bring all these experiences and write a guide, basically, for those investors who are willing to take a little bit of a deeper look and analyze what sustainable investing actually is. So what I want to do is, today, I want to cover what has transpired in this field over the last year and a half, 2 years since I published the book. And as you know, we live in interesting times, so a lot has happened. So we'll talk about this. I will also try to tell you my view about what smart investors, both portfolio managers, but also asset owners who may allocate to portfolio managers, what they should be thinking about. So to start with, let me propose that we can talk and think about sustainable investments through the lens of 3 related but distinct objectives. So number one, you have perhaps most obviously financial objectives. You may use ESG information, ESG investment ideas, but potentially a lot more to build portfolios that seek to target higher returns or lower risks. Then you have what I'm calling here values alignment. So think about broad category of non-financial objectives. Could be ethical, could be maybe universal owner objectives that may not translate into the risk return in this particular portfolio, but may be more relevant for your overall allocation, perhaps. Last not least, think about the real economy impact. So using your financial portfolio to influence, let's say, corporate or maybe even sovereign actions in the real economy. Now, this might seem obvious, but there's actually quite a bit of depth and nuance in this little framework. The reason is that sustainable investing is often thought to be a unified category, but it's not. These three goals are distinct, and trade-offs between them are just inevitable. And any given strategy in this space will have different weight on these goals, will articulate these goals differently, leading to a lot of confusions and misunderstandings unless we are very clear how we are choosing these goals. Maybe we're choosing weight of 0, not considering one of these goals and putting most of our attention on the other two. It's going to be really important to measure outcomes and actually map the outcomes to these underlying goals. That's something that I think as the industry, we haven't yet gotten to the ideal state. We're still learning how to do this. And unfortunately, still today, quite often we forget about this. We forget about these trade-offs and tensions and then measuring those. So let me show you how to think about the world of responsible investing through this lens. And as I promised, let me highlight some of the more recent developments. So I expect that most of you will know at least some of these numbers, some of these facts, but just so that we have a sort of common understanding. Number one, I will say that sustainable investing, even though it's often somewhat maligned in the media or perhaps even in the political discourse, it is a really important part of investing out there. So according to Bloomberg Intelligence, in a report that they published last year, we're on track to reach $40 trillion in assets that are ESG oriented globally in what will become a bit of a sort of tale of two continents. And I'll come back to this in a second. There are differences. Europe is punching well above its weight. So Europe, for example, is leading with about $18 trillion in assets. Now, at the same time, this is a really important category, but there's clearly very, very pronounced geopolitical and maybe macroeconomic challenges. So one of the often quoted statistics is that there are now outflows from global ESG-oriented funds. So for example, just very timely number, Morningstar in their latest quarterly analysis showed that there is 8.6 billion outflows from the category. Is it bad news? Well, no. I mean, if you go back one quarter, there were about $18 billion inflows in Q4 2024. If you go back 2 years, the first year with global outflows from ESG funds was 2023. 2024 had inflows. Now we have some outflows. I think this is basically a sign of a category maturing. We no longer have only one direction, only building up more and more assets. Now we're at the point where we're closer to equilibrium, perhaps, so with some inflows, some outflows on an ongoing basis. Having said that, there is a very clear tension, and again, this tale of two continents, you have a lot of interest in Europe. You have new regulation. You have new disclosure requirements for corporates and for portfolio managers in Europe, while the US is taking a step back. The US is de-emphasizing any potential regulation. There might be an outright politicization of the area. Now, the third, really important and really timely element is greenwashing, which has been there for a very, very long time, and a new concept of green hashing. So greenwashing is overemphasizing your ESG credentials. Green hashing is downplaying them, hiding your ESG credentials. This is something that we are increasingly seeing both from portfolio companies, but also from overall investment managers. So it's not too surprising that, again, I'm quoting Morningstar numbers here. In the first quarter of this year, you had over 300 funds that had ESG terms in their names, that changed those terms. And there's good reasons for this. There's ESMA naming rule that many of you will be aware of that is really an important driver of that. But I would suggest that at least some of these funds are basically acknowledging that perhaps some of the claims they were making are a little bit too ambitious and they need to just downgrade them. I would imagine that at least some of these funds are not changing what they're doing, but they're basically green hashing. They're no longer willing to be as open, as transparent, perhaps even about some of the ESG design choices they incorporate. So what does it mean for an investor, for an asset owner who allocates? Well, I would argue that you need to be more modest sometimes in expectations, and you need to be prepared to articulate your stance on sustainable design choices a little bit more convincingly that as a community we have in the past. So, for example, I just mentioned that there are new regulations. For example, CSRD, there's a really interesting work from the ISSB, the International Sustainability Standards Board, leading to better disclosure, better data. And that's great, but better data does not automatically lead to better decisions. What I'm concerned is that sometimes investors might use those reported metrics in a very superficial manner. There's a metric that companies report. Let's put this into the optimizer. Let's just let it do its work. Something comes out. We don't quite know what it is, but at least we incorporate the metric. That's a bad design choice. What I would argue we should be doing a lot more is thinking deeply about this data, maybe even using that data to address new questions. Let me give you two examples. We talk about climate a lot. This is maybe one category of sustainability that is pervasive around the globe. Pretty much everybody agrees, in this space agrees, that climate is an issue to address in the portfolio. There's this idea of climate risks in the supply chain. How can you map them? I have a paper, there's a chapter in the book that analyzes this as a case study. You can try to use kind of standard data, maybe scope 1 and 2 emissions of your portfolio companies, and then ask a simple question. Is a given company that I'm analyzing, does this company has a lot of business, a lot of revenue, for example, coming from partners for other firms that might in turn be very, very heavy emitters? So I think you can use some of the obvious metrics to actually transform them in a way that is more nuanced and address new questions here. Net zero alignment, do we have a kind of off-the-shelf metric, but actually is free for use? It's publicly available. We do. You can go to the Science Based Target Initiative website. You can download the spreadsheet that they kindly provided with all the firms, commitments approved and whatnot. And that's fantastic. This is really good work. But I would argue that if you wanted to be a little bit more thoughtful about those commitments, you need to dig deeper. You need to be prepared to analyze, sometimes with very messy data, maybe some of the narratives, verbal descriptions that companies give about their commitments. These are data that is very difficult to put into a template. You need to do more. So increasingly frequently we see AI uses in this space, not natural language processing. This is not new. We have been doing this for many, many years in the past, but we're doing a lot more of this. And again, I'm plugging in my work here. This is not in the book, this is more recent, but the CFA has a really nice guide to net zero investing that they published towards the end of last year. Some colleagues and I contributed a chapter, sort of specifically talking about measuring net zero alignment and bringing in some of those more recent tools. Again, with the objective of uncovering questions or answers, perhaps, that are less obvious, but cannot be very easily quantified through the kind of standard metrics that companies are supposed to report. Very importantly, impact, again, modest in expectations. We all, or most of us, I would imagine, seek impact through our financial portfolios. We want to have a dialogue, engage with the portfolio companies. Well, we often don't stop and think about what is the channel through which that impact should arise. That's a really tough question, and I would argue that there's only two possibilities here. Number one is we can have a modicum of control. What do I mean by control? Well, if you disagree with where a company is going, as a shareholder, you can vote. You can elect a new director, for example. You change the board composition and then change where the company is going. You can potentially engage with the company itself and convince them that as a large shareholder, perhaps, you have a say in where the company is going. That's kind of the obvious when people talk about this a lot. There's also a less obvious, I would argue, maybe not underutilized, but people don't think about this enough, the channel of cost of capital, of providing financing at a higher or lower price to the company. Now, the way that we structure our portfolios leads to some really poignant tensions. For example, one of the things that you see in the space is the general displeasure that portfolios that are meant to be climate aware, climate oriented, they tend to have, we think they don't have a ton of impact. And I would argue that's not a surprise, that should not be a surprise. Why? Well, think about what happens in a portfolio that is net zero aligned, but a portfolio that is aware of a climate risk. Well, that portfolio, almost by definition, will tilt away from the most heavy emitters. It will hold companies that are green. And as a manager, if you engage with these companies, if you actually prod them and and stimulate them to move to net zero, that's all great. but ultimately your portfolio companies are controlling probably a very small fraction of overall global emissions. You still have a way, perhaps, to influence those really heavy emitters you're not holding. Maybe you have a way through the cost of capital, but it's not going to be quite as effective and certainly not quite as visible as engaging with a portfolio company that you hold and that portfolio company being very, very green. Moreover, I wish there is more clarity and maybe more disclosure about engagement by investors. What I mean here is something that when I was writing the book a couple of years ago, this was just a theoretical concept. The concept was that people don't always explain why the engagements translate into higher or at least neutral impact on shareholder valuation. I was very concerned that sometimes we may have objects of engagements that seem very logical, seem very intuitive, deliver on our goals, going back to that Venn diagram a couple of pages ago, but these goals might conflict with shareholder value. Today, it's no longer hypothetical. There was a very well publicized case, a court ruling against American Airlines a couple of months ago in one of the courts in Texas that basically made this point that you really need to be careful and really need to be transparent about how the way you talk to the portfolio companies translates into shareholder value. And I think this is a kind of a warning bell, for many managers who now need to actually be able to explain that connection between we engage on something and this is why we think that this is positive or at least neutral, I would say, for shareholder value. This also explains why so many managers out there engage on transparency, engage on, can you, the portfolio company, give me more information? Can you start disclosing some items? The reason is that there's a very well-established body of academic evidence that ties transparency, higher transparency, to shareholder value. So I have a really good reason as an investor who engages with the company to back up my claim that I'm engaging on more clarity for myself and other market participants. This better transparency plausibly correlates with higher company value on a going forward basis, for example. And I'm pretty much at time, so let me just give you one last slide. What is the smarter way forward? It's like, again, I strongly believe sustainable investing. There's a lot of discontents of the area, but I think if done thoughtfully, it's simply good investing. It's simply investing that delivers on a variety of investor needs out there. But to do it well, we need to be very clear on objectives. We need to go back to that diagram. What is our stance on risk and return? What is our stance on non-financial portfolio decisions that we pursue? What is our stance on impact? We need to be transparent about the trade-offs. These goals conflict with one another. And we be very clear about the evidence. So here's what happens in the portfolio, and here's how I tie outcomes to the portfolio decisions. So with that, I thank you for your attention, and I welcome any questions, any discussion. Thank you.
Thank you, Lukasz. As a reminder, may I remind you that you're very welcome to send any questions you may have through the platform, and we will take these questions after the end of our presentations. So I'm going to give now the next 15 minutes presentation, and then we can have a discussion. So let me share my screen. Okay, I hope you can see it. I'm going to revisit two timely topics in the ESG investing field. One has to do with financial materiality and whether stock strategies based on financial material ESG scores outperform. And the second is going to be about whether divestment from institutional investors by institutional investors has real effects. So the first part actually was very deeply and nicely addressed last year by my dear friend and co-author, Professor Panos Patatoukas from Berkeley University. But we thought that it's timely again to address it because the same issues keep coming up. So to summarize what this issue is about, So we have the very general question whether stocks with high ESG scores outperform, outperformance meaning alpha generation, and the evidence is mixed. So as a result, there was a nice approach being taken about 10 years ago, where the idea was that what if one dissects the ESG scores in the material and their immaterial components, material meaning anything that affects the financial health of a company. So what if one sorts stocks on increases in the material component of ESG scores? Is this strategy going to outperform? And this was addressed in a novel study back in 2016 by Cannon, Serafim, and Yoon, where the evidence was that the so-called materiality portfolio, meaning a portfolio comprising stocks with increasing material ESG scores, outperforms, i.e. it yields a positive alpha. This study has turned out to be very, very influential. Actually, the Financial Times in 2023 called it a turning point on how investors viewed and integrated ESG information. And the results of this study were used to develop a narrative about the development and marketing of a certain ESG ecosystem, where some key ingredients in this ESG ecosystem, based on the findings of the KSY study, were the State Street R factor, the Bloomberg SASB indices, and the SASB, the Sustainability Accounting Standard Board's settings per se. Now, in 2024, in our study with Byang, Ann, Panos Fotatoukas, and myself, what we found was that after all, the KSY materiality portfolio yields no alpha. And again, because of the radical, if you like, contrast in results, our study likewise has started attracting attention from investors and media. And here you can see a few examples. So what is the idea? Why is there a difference and there is no material and no material ESG alpha after all? Well, here we saw in a nutshell what is happening. So here it's a very standard alpha estimation where we estimate the alpha of our materiality portfolio in the first column by controlling for certain factors, as is typically the case. And actually we use the same factors as in the Khan et al. Study, and we found that 22 basis points monthly alphas in the original study. But then when we enrich the benchmark portfolio by including the so-called robust minus weak and conservative minus aggressive standard nowadays asset pricing factors, then you see that the alpha goes away. It's zero. So this is not a fishing exercise expedition, if you like, but there are deeper economic reasons here. So the robust minus weak is about the profitability of the firm, and the conservative minus aggressive about the investment of the firm. And the economic rationale is that the changes in the material ESG scores do not fall from the sky, right? They're linked to the firm's fundamentals. So firms which are more financially established, meaning more profitable, bigger firms, and also firms with lower asset growth, then these firms also exhibit increases in their material ESG scores. So this distinguishes causality from correlation. It is not the material ESG score increases that drive the alpha, but in contrast, it is actually the changes in the firm's fundamentals themselves. This has much deeper implications, of course, for the marketing of certain ESG products and about the disclosures that institutional investors need to make when they report their alphas. They also need to report their benchmark, because not surprisingly, the estimation of alpha crucially relies on the specification of the benchmark portfolio. Interestingly, here you see the Bloomberg SASB indices, right? The graph terminates here in March 2024. So these are basically, these Bloomberg SASB indices replicate the type of materiality portfolios that we have also studied using different universes of stocks, the entire S&P 500 universe and segments of that. And the termination date here in this graph is not accidental. Actually, Bloomberg ceased the publication of these indices in March 2024. Of course, we do not know what is the reason that Bloomberg ceased the publication of these indices. If you have any information on that, feel free to contact us. But in our study in 2024, we had also included in our study the study of the performance of the Bloomberg SASB indices, and we found no alpha for them. This is a very powerful result because the construction of the Bloomberg SASB indices follows the State Street's R-factor methodology, which relies not on a single ESG provider, but on multiple ESG providers. So this serves as an external validity test of our results. Third, make firms greener. So what is the idea here? Basically, there are two channels. One is the engagement channel through which institutional investors engage with the management of the firm and they try to, to lead it to improve environmentally. And the second channel is a more brute force approach where you underweight the company's stock or even you fully divest from that. This is going to increase the cost of equity of the firm, theoretically speaking, and as a result, this is going to force the company to improve environmentally. Now, even though there is a large literature, empirical literature in favor of the engagement channel, on the other hand, the evidence for whether the divestment or underweighting the company's stock makes the firm greener, the evidence there is mixed. So, again, there are good reasons for this. Because the investment is about a change in ownership, the new shareholders are likely to care less from the original ones. Divestment will increase the firm's cost of equity only under certain conditions, like, for instance, if the vast majority of investors are green or if the correlations between the returns of green and brown stocks are low. And, even if the cost of equity increases at the end of the day, the firm will have to undertake some steps, some reforms to improve environmentally. This entails costs. So it's a question of a trade-off between the benefits of reforms and the costs from suffering a higher cost of equity. So in our very recent research, which has also attracted attention from investors, as you will see, with Cheng Zhu, we addressed the question whether the underweighting of stocks by institutional investors makes firms greener. And we did that in a very simple, intuitive, and direct way. So what is the idea here? If a firm faces certain climate change exposures, institutional investors are going to rebalance their portfolios if they incorporate ESG criteria. This is going to incur what we call a climate change price pressure, CCPP, and this price pressure is going to increase the cost of equity. So we can directly check whether the underweighting increases the cost of equity through the lens of this CCPP variable. So in particular, we can calculate, and we do that, CCCP for any stock in the US stock market universe. And this gives us a number for each stock at any point in time, which tells us how much the stock price changes when firm-level climate change exposures change. So with that, we can ask now three important questions. Does institutional CCCP affect firms of cost of equity? If it does it also affect firms' future environmental profile? And which types of institutional investors contribute to these CCPP effects? So we did that exercise from 2005 to 2021. And what we found is that when there is an intensification in CCPP, meaning that when investors sell more, driven by climate change exposures of the firms, the cost of equity goes up by 6% of the average cost of equity. However, this does not make firms change their future environmental profile where we measure the latter by green patents and carbon emissions and other expenditures for green activities. Interestingly, what we find is that banks rebalance their portfolios the most with respect to changes in regulatory climate change exposures, whereas this is the case for insurance companies with respect to physical climate change exposures, so this is not surprising. On the other hand, brokerage firms do not react at all because they simply pass orders, right? So they do not really care. If you want to visualize what is going on, this is the CCCP, the average one, across all stocks over our period. You see at the beginning, the CCCP was positive, but then it turned negative. So here is where the underweighting is expected to occur. And then it's becoming positive, and that's exactly what we have when we study the response of the portfolio weights with respect to climate change exposures. You see, this is the point where investors, on average, underweight. So this CCCP measure can be calculated for any stock you wish, as long as you have, of course, the required inputs. But once you calculate that, this is super useful, we believe, for policymakers and investors. We can identify using that greenwashing from investors, so whether investors walk the talk. And we can also identify which firms are under pressure by institutional investors. So what are the required inputs? If you want to implement this in real time, you need your portfolio weights, the portfolio weights of all involved institutional investors, actually. You need, of course, a proxy for the firm's climate change exposure. This can be either hard information like ESG ratings or soft information coming from AI, as Lukasz mentioned before. We also need the sensitivity of its investors' portfolio weights to changes in climate change exposures. You also need to know each investor's stock ownership and the demand elasticity for each investor. Again, this has attracted a lot of attention. You see here a couple of examples. You can read more in the press. So just to give you an example, for real examples, for the big three in the institutional investing space, in Vanguard, State Street, and BlackRock, you see here how their sensitivities, so these are the sensitivities of their portfolio weights to climate exposures. Here is the zero line. You see, sometimes this sensitivity is positive, some other times it's negative. So it's not that whenever the climate change exposure of a firm goes up, the institutional investor underweights. Why is that? Well, because the increase in the climate change exposure may also be representing an opportunity. It's not just risk. And you also see how heterogeneous these three investors are, right? So in general, there is heterogeneity across investors on how they perceive the effects of these changes in climate change exposures to the risk of their portfolio and to their return. So here you see another example how this can be used for detecting greenwashing. I'm not going to reveal the name of the investor here. So this investor is a global leader in sustainable investing. More than 90% of its AUM is managed in ESG integrated assets. And you see how their sensitivity evolves over time. Again, this is the portfolio sensitivity to changes in climate change exposure. So sometimes it underweights, but some other times it also overweights. Finally, here we can see which firms are under pressure. So I'm giving you again three examples: the Apple stock, Pfizer, and Procter & Gamble. So this is, how much their stock price changes when there is a one standard deviation increase in the climate change exposure, right? And you see that even though the pattern is quite similar across these three firms, which are coming from different industry sectors, still there are differences, right? And you see, interestingly here, the 2015 period is a period where all these three companies were under severe pressure, I would say, from institutional investors. So to conclude, what do we know from all this? Well, we now know that there is no material ESG alpha if the benchmark model is correctly specified. The outperformance is driven by firms' fundamentals and not by increases in material ESG scores. We should be very careful how we market certain financial products as ESG and outperforming. Investors could target an ESG score by simply selecting portfolio stocks on fundamentals. There is no need to know the ESG information per se. And finally, regarding the efficacy of sustainability accounting standards, it's always nice to promote, your product by saying that it delivers alpha. But this is not the right metric to do when it comes to sustainability accounting standards, right? So alpha should not be the evaluation metric. Actually, we saw that the SASB standards do not deliver alpha, but this does not mean that they're useless. On the contrary, they're super useful because they can also serve other purposes, such as the disclosure of information that Lukasz also talked about. Institutional investors can affect cost of equity, but they cannot affect firms' environmental profile via divestment. And engagement is the way to go. That's why the importance of climate coalitions is so big. That's why it's very important to know if this sort of even, weak tendency of certain institutions to depart from climate coalitions is going to continue or it's going to revert. We're going to say more about this at the very concluding section of the conference. And finally, these CCPP metrics are very useful to regulators and investors. Knowledge of that can foster firms' green investments, and it can detect investors' greenwash. With that, I conclude here. You can find more information on the website in these articles, and of course, you're very welcome to contact us as well. So let's check if there are any questions. Okay, right. Okay, so Lukasz, here is a question for you. So what should we take after all? I mean, can we do well by doing good? I mean, personally, I know also your very interesting paper on the ESG, efficient frontier. Can you please clarify this?
Sure. So, I would perhaps warn you that my answer will be the typical economist answer, which is it depends. Here's what it, but at least I can tell you what it depends on, and at least I can give you a sense of magnitudes. So I will say that if your sole intention is to maximize your financial outcomes, so generate the highest possible risk and return, let's say, then you probably will still use ESG information. As you said, you need to be very careful which information you incorporate. Some information is really interesting, very relevant for some cases. It's just not a meaningful driver of risk of return. So you need to do your homework basically. But once you do, I do believe that it's going to be probably a minority, but there's going to be a very meaningful minority of investment view that will source through investment ideas that have to do with sustainability. So that's for the purely financial outcomes. But I will also say, and this is going to be the use case for most people I would expect on this call, and very many investors globally, financial outcomes are not the only thing that matters. They're extremely important, and if people didn't care about them, I would not have the job that I do. But at the end of the day, the goal of many investors, many asset owners, is to build a portfolio that not only delivers a high enough risk and return outcome, on average at least, but also a portfolio that conforms to a variety of non-financial objectives. And maybe the most obvious ones are just ethical ones.
Okay.
If you have an ethical view that clashes with some exposures in your portfolio, of course you will incorporate this.
Okay.
And then the problem becomes, how do you manage this to not jeopardize your financial goals too much? And the paper that you kindly mentioned tries to understand this. And I will say that, but one of my favorite kind of insight from the paper is that if you're not too aggressive, if you wanted to improve purely ESG profile of your portfolio, and you're not asking too much, you can actually you can never have a cake and eat it, but you can have that benefit with very low degradation to financial returns, meaning that you can achieve first-order improvements in ESG with only a second-order haircut in terms of your Sharpe ratio.
So, okay, given we have less than 1 minute, let me take also this question as a follow-up. And if you can please simply give a very quick answer. So, given what you just said, it says, so what would you say to pensioners? Sacrifice returns so that the portfolio is greener? Just a quick answer, please, so that we move on.
So the quick answer is that to the extent that you can tie this to financial outcomes, you absolutely should. The investment committee of a pension fund can tie a climate outcome to risk or return, you absolutely should consider this. And my concern is that very often we will just prefer not to talk about sustainability, even if there is potentially a material link to outcomes, financial outcomes.
Okay, great. A very last question, just very quick answer again. So is ESG something new after all, or we knew for ages? For instance, the quality factor with former colleagues of yours at the AQR. So is it just a rebranding here of the name?
So I think it's different, where the commonality is, and this is very much what you talked about in your very informative talk just now. There is a correlation. A lot of things we consider ESG are the same things, but we consider good quality, but we consider, part of our investment ideas. That's okay. There's nothing wrong with this. I don't think that this should be very surprising. So, so in that sense, it's not new. What is new is being very explicit about building a portfolio for those three different goals that I mentioned. Not only financial, also non-financial, also real economic impact. That approach is newer. Right. I mean, not new, but a couple of decades old now.
Right. Okay, Lukasz, I think our time is up. So thank you very much for being with us.
My pleasure. Thank you.